A balance sheet is a statement of the assets, liabilities, and equity at a particular point in time. Let's see how it looks. The top section is for assets. The bottom one is for liabilities and equity. That's why it is called funds. We can say that it shows the sources of funds for our assets. Right now, it has two accounts: cash and earnings. That's mean that we hold some cash, and this cash earned. These accounts calculated automatically. We can click one of them and look at the details. Earnings are calculated as the difference between revenue and expenses. If we scroll down and take a look at the chart, we also can say that earnings are a cumulative result of our operations. Let's move back to balance. In the beginning, I want to show you how to set the initial cash amount. First, we need to find out how much money is available. Assume that it's 5,000 more, and our cash balance should be about 16,000. So we have to add a new operation, and increase our earnings. For that, we'll create a new category. For the future, we'll add an aggregate that will be used for all categories, related to the balance sheet. The category will be a revenue type, and we will call it BEG balance. Since this is a beginning balance, we'll add an operation to the past year. So it does not affect the statistics of the current year, at the analysis page. Now our cash balance is correct. Take a look at the beginning balance in the previous year. If we click the cash account, we will see that the BEG balance is summed into total, and increases the accumulated result. Please note, if we add a new operation, cash and earnings accounts will be recalculated automatically.